3 weeks ago, I observed something in a dataset that I nearly overlooked. A figure on the Shanghai Futures Exchange Vault report had shifted. Not marginally, substantially. So I opened a spreadsheet and began monitoring it daily, then weekly. And what I discovered pulled me into an investigation that I haven't been able to step away from since. If you possess physical silver, if you maintain mining stocks, if you've been observing the price decline and questioning whether you made a catastrophic error or whether something else entirely is unfolding, this analysis is going to provide that answer. I'm going to guide you through precisely what I discovered in the sequence I discovered it so you can observe what I observed. And somewhere around the 12-minute mark, you're going to encounter a piece of information that will make you pause and review. I know because that's precisely what occurred to me. It began with one chart. If this analysis reveals something the mainstream overlooked, hit like and subscribe. It helps the algorithm distribute this to those who need to witness it. The Shanghai Futures Exchange publishes its vault inventory data. This isn't opinion. This isn't speculation. It isn't someone online guessing. This is the exchange itself documenting how many tons of physical silver are positioned in its warehouses. Actual bars, actual vaults, audited figures that get refreshed daily. I accessed CEIC, one of the most respected economic data platforms globally, and extracted the time series. In mid-December 2025, the SHFE documented approximately 900 tons of physical silver in its vaults. The figure I observed on February 4th was 423 tons. I examined it, then I refreshed the page. Identical figure, so I extracted the previous day, 449. The day preceding that, 462. The day before that, higher still. I traced back day after day after day. Every single entry was smaller than the preceding one. Not most days, not on average. Every single day the figure declined. I extracted 6 weeks of data and couldn't locate a single day where inventory increased. That's not a fluctuation, that's not seasonal, that's a one-way trajectory. Silver is departing those vaults and not returning. Let me ensure you actually comprehend the magnitude of what I'm describing, because figures without context are merely noise. 900 tons to 423 tons in 7 weeks. That's a 54% drawdown. More than half of China's primary exchange, silver vanished in less than 2 months. The weekly drainage rate is 42.6 tons. The daily drainage is 10.78 tons. And if you overlay the chart, the angle of decline is becoming steeper, not flatter. The drainage is accelerating. Now, position that in global context. Combine the SHFE vaults with the Shanghai Gold Exchange vaults, and you obtain roughly 900 tons total across all Chinese exchange-accessible silver. That's 29 million ounces. Sounds substantial until you realize that the world consumes over 1.2 billion ounces of silver annually. All of China's exchange silver covers 2.4% of 1 year of global demand. 2.4%, that's not a cushion, that's fumes. Now I'm going to accomplish something that none of the articles about this data accomplished. I'm going to calculate the trajectory forward. If the drainage rate maintains at 42 tons weekly and current inventory is roughly 412 tons according to the latest improved terminal data, then you divide 412 by 42 and you obtain 9.8 weeks, call it 10. In 10 weeks at the current rate, SHFE silver vaults reach zero, not low, not concerning, zero. Empty shelves, nothing remaining to deliver against futures contracts. Now, if you're positioned in physical silver or silver miners right now and you just witnessed a 53% price decline, I need you to comprehend what this figure signifies for you. The exchange that backstops a substantial portion of Asian silver price discovery is depleting its metal. I'm not predicting this will occur. Drainage rates can shift, metal can flow back in, but no one in the mainstream financial press is even calculating this projection, and that alone communicates something about the quality of the coverage you're receiving elsewhere. Now, here's where my research took its first unexpected direction. I wanted to determine if this was exclusively a China narrative. Perhaps Chinese industry is extracting metal for solar panels and electronics, and this has nothing to do with anything broader. That would make sense. China is the world's largest consumer of industrial silver. Case resolved, correct? So I extracted the COMEX data and my stomach dropped. COMEX is the primary silver futures exchange in the United States, operated by the CME Group. It's where paper silver gets traded and where theoretically you can demand physical delivery. According to data documented by multiple sources, COMEX silver inventory dropped to 415 million ounces in late January 2026. That's the lowest level since March 2025, a 34 million ounce drawdown from its recent peak. But here's what genuinely captured my attention. According to detailed analysis, the registered silver on COMEX, and registered signifies the metal that's actually earmarked and available for delivery against futures contracts, has been witnessing major outflows since September 2025. Eligible metal, which is metal stored in COMEX-approved warehouses, but not yet designated for delivery, is being converted to registered just to satisfy the demand from individuals standing for delivery. And here's the critical part. The exchange isn't bringing in new metal. No fresh silver is arriving in the vaults. They're simply reclassifying what they possess. It's like a restaurant depleting its food and renaming the appetizers as entrees. The menu appears full, but the kitchen is empty, so it's not just China. COMEX is draining too. Two of the three largest visible silver inventories globally are losing metal simultaneously. At that point in my research, I didn't want to examine the third because I already suspected what I would discover. I accessed the London Bullion Market Association data. The LBMA operates the largest physical precious metals market on Earth. And according to analysis published by multiple precious metals researchers, the LBMA's estimated free float, the silver that's actually available to settle London's massive unallocated accounts, has collapsed to what one source described as the lowest level in modern history. According to detailed reports, for the first time in modern history, all three major transparent silver inventories, Shanghai, COMEX, and London, are draining simultaneously at record speed. Reports estimate that nearly 1 billion ounces of refined silver have vanished from visible stocks since 2021. Now pause. I need you to maintain those three facts together. Shanghai draining, COMEX draining, London draining. Identical direction, identical time, identical metal. There's no historical precedent for this. If this were occurring to oil, it would be the lead narrative on every financial network globally. If this were occurring to copper, congressional hearings would be scheduled by Friday. But it's silver, so you're hearing about it from independent analysis instead of from the front page of major financial publications. And frankly, that's part of the narrative too. So the next question is obvious, and it's the one that kept me investigating until early morning. Who is acquiring the metal? Because silver doesn't evaporate. It doesn't dissolve. When it departs an exchange vault, it goes somewhere. Someone signed a delivery warrant. Someone arranged armored transport. Someone possesses those bars. And whoever it is, they're accomplishing it simultaneously across 3 continents. Let me communicate what I discovered on the COMEX side. And I want to be transparent about what is confirmed data and what is my inference. On January 7th, 2026, a single day of COMEX deliveries moved 8.1 million ounces of physical silver. According to detailed analysis, JP Morgan delivered 99% of that total. One bank, 8 million ounces, one day. But here's what perplexed me. After that massive delivery, you would anticipate demand to cool. Contracts fulfilled, buyers satisfied, open interest declining. That's how delivery months normally function. But that's not what occurred. Open interest increased. New buyers were accumulating as rapidly as the old ones were getting filled. And according to analysis, something even stranger was occurring in the background. Traders were rolling contracts backward, taking March delivery positions and pulling them into January and February. In normal markets, individuals roll forward to delay. Here, they were compensating extra to accelerate. They wanted the metal sooner, not later. Now, the simplest explanation is that they don't trust it will be there if they wait. One analyst quoted put it bluntly, "If this is what's occurring, the COMEX could end up in substantial trouble." Now, let me return you to China, because while the vaults were draining, something else was occurring that transforms the entire interpretation of the narrative. And this is the part where I transitioned from thinking this is interesting to thinking this is deliberate. On January 1st, 2026, China's Ministry of Commerce implemented new export controls on silver. I accessed the original announcement and cross-referenced it with reporting. According to reports, state media quoted an unnamed industry insider who stated the new policy formally elevates silver from an ordinary commodity to a strategic material. Let that language register. Strategic material. Identical regulatory footing as rare earth metals, the identical category China utilized to bring the West to its knees over magnets and semiconductors. Under the new regulations, only 44 large state-approved companies that produce at least 80 tons of silver annually and maintain substantial credit lines are permitted to export. According to analysis, this effectively restricts 60-70% of the world's refined silver supply to domestic Chinese use. Hundreds of smaller and mid-sized exporters who had been supplying silver to global industrial users for decades are now locked out overnight. Industry leaders responded by noting that silver is needed in many industrial processes. According to reports, within days of the announcement, Chinese companies contacted Canadian miners offering to purchase physical silver at $8 per ounce above market price. An Indian buyer followed the next day, offering $10 above market. That's how you know a restriction is genuine. When buyers start contacting miners in other countries and offering premiums just to secure metal, China didn't ban silver exports. That would have been too obvious. It accomplished something more effective. It created a licensing bottleneck so narrow that most of the world's silver refining capacity is now functionally landlocked inside Chinese borders. Now follow this timeline with me, because this is where my investigation transformed direction entirely. I started mapping the vault data against the policy dates, and a pattern emerged that I wasn't anticipating. October 2025, China's combined SHFE and SGE vaults maintained roughly 1,190 tons of silver. That was the starting point. By November 21st, just 51 days later, those identical vaults maintained 519 tons. According to detailed analysis, 670,000 kilo of silver disappeared in under 2 months. That's 21.55 million troy ounces. And here's the detail that remained with me. On November 21st alone, another 15,119 kilos were removed. The price of silver was declining that day, not rising, declining. Normally, when price drops, sellers appear and buyers retreat, but someone was extracting more metal out on a down day. That's not speculative behavior. That's strategic accumulation by someone who doesn't care about the daily price because they're operating on a completely different timeline. Then something strange occurred in December. SHFE witnessed a 129-ton inflow, the highest monthly inflow in 17 months. It appeared like the drainage might be reversing. Some analysts breathed a sigh of relief, but it didn't reverse. By mid-January, the drainage resumed harder than before, and it hasn't stopped since. Here's my honest interpretation of this pattern, and I want to be clear. This is me connecting elements, not stating confirmed fact. China restocked its exchange vaults briefly in December, right before the January 1st export controls went into effect. Metal flowed in during December. Then the export door slammed shut on January 1st, and now the metal is flowing out again. But this time, it cannot depart the country. It's staying inside China, being moved from exchange vaults, which are visible publicly, to somewhere else. Industrial facilities, government stockpiles, military reserves. We don't know precisely where because that data isn't published. But we know it's departing the exchange system, and we know it cannot depart the country. Someone is moving silver from the public ledger to the private one inside a closed system. Now, while all of this was occurring, the only investment vehicle available to Chinese citizens who wanted silver exposure was being systematically shut down. A major silver futures fund is the only publicly traded fund in China that invests directly in silver futures. I want to ask you something before I continue. Examine those 4 steps: export controls, vault drains, fund lockouts, Western price crash. Do you think that sequence is a coincidence, or does it appear coordinated to you? Communicate in the comments, because what I'm about to present you next made me select a side. I want to present you a historical parallel that made this entire investigation click for me, because patterns matter more than predictions. In 2005, China began stockpiling copper at a pace the world had never witnessed. Exchange vaults drained, prices were still manageable. Western analysts scratched their heads. Why is China purchasing so much copper? The answer became obvious within 18 months. China was building strategic reserves ahead of the largest infrastructure build-out in human history. They were purchasing everything they could at every price they could manage before their own demand made the metal unaffordable. The copper price didn't double. It tripled within approximately a year. And by the time the rest of the world figured out what China was accomplishing, it was too late. The metal was gone. The reserves were built. And the new price reflected a world where China maintained the inventory and everyone else maintained IOUs. Now examine what's occurring with silver in 2026 and communicate to me if the pattern doesn't appear identical. Vault drawdowns accelerating. Export controls locking refined supply inside the border. Only 44 state-approved companies allowed to ship anything out. Retail investors blocked from competing through fund suspensions. The paper price suppressed through a combination of margin hikes in the West and fund lockouts in the East. The playbook is identical, but the stakes are higher because in 2005, copper wasn't simultaneously being designated a critical mineral by the United States, discussed for international price floors by 55 nations, and about to be remonetized by the world's largest democracy. Silver possesses all of that. And the vaults are emptying faster than coppers ever did. Now let me provide you the figure that ties this entire investigation together. And this is the part I communicated to you about at the beginning, the part that made me pause and review my own notes. China's export controls went into effect January 1st. At the current SHFE drainage rate of 42 tons weekly, the vaults approach zero around mid-April. I verified that calculation 3 times, mid-April. Then I examined something completely unrelated. India's Reserve Bank has issued new regulations allowing silver to be utilized as formal bank collateral effective April 1st, 2026. The first remonetization of silver by a major economy since the 1800s. 1.4 billion individuals gaining access to silver as a monetary asset. I examined the 2 dates side by side. The week the Chinese vaults approach empty is the identical week India goes live with silver as money. I sat back from my screen and didn't type anything for approximately 5 minutes. I didn't manufacture that convergence. I didn't cherry-pick dates to create a narrative. I calculated a drainage rate forward on a calculator and verified a regulatory calendar, and they landed on the identical week. April 2026. Chinese vaults approaching zero. Indian monetization going live. The world's factory depleting visible silver at the precise moment the world's largest democracy communicates to its population that silver is money. When I witnessed that, I comprehended that this narrative isn't just about inventory data. This is about a once-in-a-generation restructuring of who maintains silver. In what form and under whose regulations? Now let me communicate to you what this signifies if you're invested in silver, because data without implication is just trivia. The paper price, the figure you observe on your screen, the figure that made you sick when it reached 57. That price is established by exchanges that are depleting the physical metal they need to back those prices. SHFE approaching zero, COMEX registered bleeding since September, LBMA free float at historic lows. When the physical depletes, the paper price stops being a market price and starts being a fiction. And fictions don't survive contact with the delivery notice. The question every silver investor should be asking right now isn't where is the price going this week. It's what occurs to price discovery when the vaults that underpin it are empty, because that moment isn't theoretical. It's 10 weeks away on the SHFE side, and no one on mainstream financial television is even discussing it. There's a line from analysis that I haven't been able to get out of my head since I read it. When the last readily available bar departs the vault, the price discovery mechanism shifts from whatever the paper market can bear to whatever it takes to extract the last ounce out of private hands. Read that again, whatever it takes. And every day, the quantity of bars between here and that moment gets smaller. Shanghai is at 412 tons and declining. COMEX registered is bleeding out since September. London's free float is at a level that multiple analysts describe as the lowest in modern history. The 6-year structural deficit hasn't reversed, and the world's largest refiner just sealed the exit door shut. The question isn't whether the vaults will empty. At this trajectory, the question is which vault empties first. I want to leave you with a question, not an answer, because I think this audience is intelligent enough to draw their own conclusions, and I would rather arm you with data than opinions. If you were a government or sovereign wealth fund or state-linked industrial conglomerate and you knew that silver had just been designated a critical mineral by the United States, discussed for international price floors by 55 nations, and was about to be formally recognized as money by the world's largest democracy, and you also knew that you had just locked 60-70% of global refined supply inside your own borders, what would you be accomplishing right now? Would you be selling? Or would you be quietly moving every bar you could obtain from a public exchange vault into a private one while the rest of the world observes the paper price and thinks the trade is dead? The vaults don't lie. They publish the figures every day, and every day the figure is smaller than the one before. Silver isn't crashing because nobody wants it. Silver is crashing because someone wants all of it. And they need the price low enough to acquire it before the regulations transform. If you maintain through this crash, you're not incorrect. You're early to a situation that the rest of the world hasn't figured out yet. The data is on your side. The vaults prove it. And in the next analysis, I'm going to present you precisely what occurs when those vaults approach zero and the paper market collides with physical reality. What I discovered will transform how you think about the price you observe on your screen. I'll keep observing. I'll keep tracking every vault report, every data point, every delivery notice. And when those vaults approach zero, I'll be here to present you what occurs next. 10 weeks. The clock is operating. This isn't financial advice. This is what the data demonstrates. What you accomplish with it is your decision.